is still a highly fragmented industry. So that the big names that you know, they still only control about 35% of the overall self-storage market. So that still leaves about 50% of the overall self-storage market, Jason, is still moms and pops. These are onesie, twosie facility owners.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Ballara, and this is the Know Your Why podcast. Today I'm here with Tom Dunkel. Tom has a background in corporate finance and 25 years of real estate and investment experience. Tom brings his extensive experience to the Bellrose Asset Management. And Tom, as I mentioned, your bio, very impressive, but I want the listener to get to hear it from you. So I'm kind of leave it there, and I'm going to just say, first of all, thank you for coming on the show today, taking out the time in your morning and coming to share your story. So thank you very much.
Yeah, Jason, thank you very much. Great to be with you and the listeners. And yeah, happy to jump right into my background. So I started out after business school in corporate America, like a lot of folks, just trying to, battle my way up the corporate ladder. Thankfully, I was found myself in a great position. I was doing mergers and acquisitions and big capital raises for an aerospace company that was growing aggressively through acquisition. And I was just surrounded by such amazing people. The young CEO of the company was a Harvard undergrad, Harvard MBA, first Boston investment banking guy with just a big vision. My boss was a Gold Glove boxer at the Naval Academy, did his tour in the Marines, and then went to Wharton Business School, and just an amazing, compassionate leader. And then I was around some amazing financial people as well. And so I really learned the nuts and bolts of deals and of growing companies and and building businesses. So I was thankful to have that foundation early on in my career, but I knew that climbing the corporate ladder and just clawing through all that was just not ultimately for me. So fast forward about 12 years, and I find myself actually getting fired from my corporate job, which was the kick in the pants that I needed, Jason, to finally go out on my own and start my entrepreneurial career. So that was 2006. 2006, of course, probably not the best time to get into real estate, but that's what I did. I jumped in with both feet and a pile of cash that I had saved along my corporate life, and proceeded to blow through all that the next few years as the market tanked. And I learned a lot of hard lessons those first few years, but I persisted and just knew that I didn't want to go back to corporate America. So I just stuck it out, started finding niches and great people to surround myself with. And thankfully, now I'm 17 years into my entrepreneurial career, built a really great team. We're now in self-storage, which we found about the 2017, 2018 timeframe. We didn't buy our first facility till 2020, but we're now about to close on our 14th property. And, I'm just in a position where, just looking to continue to build the team, build the marketing, and all those kinds of things. So that's the high level overview. Happy to dive into any of the details that you might want to get into, Jason.
Yeah, thank you for sharing that. And I think, there's a couple of things that are interesting there to me, and I think maybe relevant to the journey, but I do want to kind of go back to early corporate America, where in your career and you were in mergers and acquisitions. And I think that I find that, a lot of people that come on the podcast have come from a different career, right? They didn't, they weren't born as a real estate investor. They didn't even probably go to college to be a real estate investor, that kind of thing. We just come to it from another space. But the background of mergers and acquisitions, and as well as raising capital, are obviously very, very relevant to getting into real estate and real estate investing. So do you feel like that helped prepare you for that transition? What sort of skill sets, what things that you learned sort of early on do you think helped kind of propel you through this journey in real estate investing?
Yeah, great question. Yeah, without a doubt, learning kind of the nuts and bolts of the financial markets, financial modeling, and not only that, but the research that goes into developing and substantiating your projections. Because of course, we're not living in a vacuum. We were raising institutional capital, so I had to be able to defend my models not only to our internal C-suite, but also to our private equity sources and our banks and outside investors. So I was a spreadsheet nerd, so I taught myself how to really use Excel and how to build like big models that span multiple tabs and link together and all that stuff. And but what's funny, Jason, is that even though I still use those skills to this day, it's really what any first year business major is going to learn in like finance 101, right? It's discounted cash flow analysis. And but the trick and the kind of the art of it that I've learned over the years is like I was saying, the research that needs to go into every assumption, because at the end of the day, I can make the model say whatever I want it to say, right? I can tweak an exit cap rate or a revenue growth number, or this or that, and I can make the model spit out these great numbers. But if they're not real and they're not I can't substantiate them, I can't go to my investors with a straight face and say, hey, this is what we're going to do, and these are the returns you're going to make. So I learned very, very, very early on that under-promising and over-delivering, while it might hurt at the time that you're doing it, it's really the way to play the long game in real estate and any other venture where you're raising capital and making projections. Because we, at these days, right, we're investing in our own deals alongside of our investors. So, we're certainly not out to fool ourselves or anybody else with some funky models. And, sadly, that's something that it can happen, right? Especially these big funds, like we're in self-storage, right? Self-storage has been, very much in the news. It's very much in the spotlight recently. There's been tons and tons of institutional capital raised to acquire self-storage facilities. And now the market's kind of dried up, and here are these big funds with all this money sitting there. I mean, they're going to be tempted to tweak their models so that the returns, look good, because they have to deploy this capital. The last thing they want to do is return capital to their investors. So, I would say that, so it's more than just putting a model together and making the projections. It's, can you look at your investors? And for us, right, our investors are, they're trying to reach financial freedom. They're trying to build wealth, maybe some generational wealth. And, I need to be able to look at them as the chief investment officer at Bellrose Storage Group. I need to be able to look at them in the eye and say, yes, I believe that these projections are reasonable and achievable. And is there risk? Of course there's risk. And I'll be the first one to point out what I think the risks are in the model, but I'll also be able to point out what the upside potential is so that we can hopefully limit the downside and maximize the upside. But that's really the story. I don't want people out there who are sponsors or, raising capital. I don't want them out there, over promising and under delivering. You need to do it the other way around, even though it might hurt in the short run.
Yeah, no, it's a great point, because I think it does happen, certainly. And I think it's very tempting, especially when you're sort of early on in your capital raising journey, in the sense that you feel like in order to get someone to sort of get on board with your investment, you have to show these, sort of really outsized returns that are, sort of, you think that you need to make the returns projections look better than everybody else's return projection. That's kind of this, I think, mentality that people get into. And frankly, I was tempted to do it at the beginning too, but because you would see these other deals put out there, these other offerings, and people would have these high numbers, and it's like, I'm not, I'm underwriting and not getting that. I don't understand how they're
Right.
doing that. And
Yeah.
really at this point now, when I see returns that look, sort of almost too high, I personally find it hard to believe. I'm like, something must be something must be off, because how can this person get such better returns than everybody else? And I mean, it may be valid, maybe they got the best deal in the world, but I think just in terms of what you're saying, to play that long game, you'd much rather underpromise and overdeliver than the opposite, right? Like, no investor is going to be upset that you give them more money than you said you were going to, but if you give them less, then they certainly will notice that. So I think it's just kind of that, are you trying to do one deal, or are you trying to just, are you trying to make this a career, that where you can last? So I love that you pointed that out. You said that you started looking at self-storage in 2017, but you kind of dove into real estate in 2007. So where did you start? What were you doing at first? And we'll get to that sort of transition from into self-storage too, but I'm just curious kind of how it began for you.
Sure. Yeah. I think, like a lot of folks out there who jump into real estate, I started out doing residential wholesaling, picked up some rental properties. I grew my rental portfolio to about 15 units, and did some fix and flip kind of things, renovate properties and resell them. And so that became really difficult, when the bottom's dropping out of the market and capital's becoming scarce and that kind of thing. And I was, and anyone who knows about the residential wholesaling business knows that, there's a big marketing, there's a big marketing expense each month. So that was really, just burning through my cash as I'm, waiting for properties to sell, or, this or that. So when that really came to a halt for me in 2009, I started, I had been looking for, what's the next thing? Because I knew it just wasn't a long-term play for me to be in residential. So I started, I started hearing about distressed mortgage notes. So I bought a couple of reperforming distressed, well, I guess they were not distressed anymore. They were reperforming loans. And that just sort of piqued my interest, because my prior corporate background in finance, so it kind of married up real estate with finance. And so that really kind of clicked with me. So at that same time, I was at a real estate networking event, and I met a guy named Joe Downs, and we've been business partners ever since. So we've been partners over 13 years now, and we've built a company called U.S. Mortgage Resolution, which now has purchased over 12,000 loans, and we've generated over $53 million of revenue in that business over the years. So we started out with $12,000 and bought 6 loans, and just sort of grew from there. But along the way, we realized, as great as that business was, it was very volatile, very unpredictable. And so me being, a business school guy, it's like, well, I can't build a business plan. I can't build KPIs around this business, because we're really just at the whim of the banks that are selling these loans. We can't knock on the door of Big Bank USA and say, hey, sell us some loans. They work at their own pace. And so it made it really challenging to really build a sustainable business there. So along the way, we've been looking at other asset classes. We had a hard money lending business that we failed at. And so since we failed at it, we thought, well, let's try that again. And then we failed at it again. So we just couldn't get the right people, the right traction. We were partners in a title company for a little while. That was just, that's a really difficult business. So when we discovered self-storage in like 2017, 2018, we were like, you know what, this business is, we did our research, right? We got educated. It's very steady, very predictable. In good times, bad times, everywhere in between. It's a very steady asset class. And we thought that this is the type of asset class where we could really build a predictable business. We could build a team. We could build systems and processes to really take advantage of this highly fragmented but growing market in self-storage. So that's kind of what led us to storage, and I think we approached it the right way, and it seems to be paying dividends now, Jason. Which is, we didn't jump right in and buy a facility, right? We took our time to get educated. So we joined a self-storage mastermind group in 2019, and it was through that mastermind learning process that we discovered, hey, we've got some holes in our team. Like Joe and I are good finance and business and kind of visionary kind of guys. And we can raise the capital and we can do the due diligence and the underwriting and stuff, but we were not good at finding these facilities. And we certainly didn't know how to operate them. So through our mastermind community, we were able to fill those two key gaps. And that gave us then the confidence to go out and buy our first facility in 2020. And then we've just been on a roll since then.
Those are really great points. And I think a lot of people should probably rewind that little section and hear that again in terms of getting the right team members in place around you. And I think, fortunately, you had a number of years of business experience that I'm sure, maybe it's a different team in self-storage than it might be in note investing or wholesaling or, whatever the case may be. But it's definitely important to recognize, as you said, where those holes are, where you're lacking in your strategy. And it's because at the end of the day, if you really want to grow a business, it's nearly impossible to do it all yourself. So you've got to figure out what pieces are you missing from your own, even if you have a partner, you may have some complementary strengths, but you may also have some similarities. And it's like, how do we fill in those gaps with other talent? And then I think that's an important piece to really take note. How did you do that? I know you said you were in the mastermind, realized, these are the things that we need, but then what did you do to go about finding those people to fill those spots? What was your process there as someone who has done a lot, in the business world?
Yeah, that's a great question, Jason. I think it was just a matter of kind of taking a who, not how kind of mindset to our problem solving. So there's a great book out there called Who Not How, and actually the book didn't even exist back then, but having now read the book, I'm like, oh, that's kind of what we did. But when Joe and I, through the mastermind process, discovered that we had these gaps in our team, we just started talking to people like, hey, who do you know that is really good at lead generation, finding these off-market deals? And through just networking and talking to our mastermind peers, we found a guy named Tim Kane. And we were talking to Tim, and he's like, yeah, I'm generating all these leads, but I'm not really very good on the finance side and the capital raising side. And we're like, okay, we are. So we brought Tim in, and we're like, okay, well, all right, now we can find the deals, we can get them underwritten and closed. What are we going to do about operations? So we started talking to our mastermind group about operations. Like, we need somebody that can help us transition from the old owner to our new management platform, and then really, get us started with a manager and marketing and getting us on Google Ads and SEO and all those kinds of things. And so again, through that same kind of networking and discussion process, we found Catherine East. Catherine is a nationally known speaker and operations expert in the self-storage industry. She's been a consultant on hundreds of facilities all over the country for the past more than 15 years. And so we brought her on the team, even though she's not technically, an employee or, a partner or anything like that. She is on our team. And that's something I would express to folks out there that are looking to build a team is not everyone has to be, under your roof.
Right.
They can be external to your business, but still be a super valuable team member. So, any of your, bankers, brokers, attorneys, mentors, coaches, consultants, I mean, all those people are just so critical to the growth of your business. But they don't have to be, they don't have to wear my Bellrose Storage Group shirt to be on the team. So we found Catherine, and and so we've been working with her ever since, and she's been with us every step of the way, and so she's bringing her team and her expertise to bear, and so it's really finding those different pieces of the puzzle. But yeah, I mean, it just came down, Jason, to just networking and being around the right people, and that's made a huge difference for us.
Yeah, and I think the networking piece is super important. And also, just as an aside, Who Not How is maybe my favorite book. In terms of business and entrepreneurship, it just in large part because it's had such an impact on a mindset shift for me, because I definitely have been a DIY guy. But your point about the team members don't have to wear your shirt is really a great point, because and I think it's something that, like, for me, coming into this world from outside, like, there are certain industries where everything is very separated, right? It's like, this is my company, all the people that are involved in my company work here in this building, that kind of thing. But what I find is really cool about real estate is that sort of collaborative nature, and the ability to just find people that have really a specialized skill, and they can actually help multiple people rather than just being their own, being sort of under one roof, as you said. I just think it's a really great point that I didn't probably fully comprehend until sort of really diving into real estate, and what that sort of abundance mindset is, and where people are very willing to help each other. And you have like a lot of these mastermind groups, and it's like you're finding team members that way, and just kind of realizing that how important that can be to business growth. And probably there are industries that are really the industries that are missing that are probably not going to have that sort of high level growth. I think the collaborative efforts can really be a win for everybody. So I think I love hearing that out about your story, because I think it does get missed, certainly in other industries, to be so closed off to those opportunities and the people that are accessible to help you. They may just not be on your payroll, essentially. So
that's right. Yeah.
With your sort of journey into self-storage, the asset class, I think, is becoming more and more popular. Maybe not becoming, maybe it's become pretty popular. But I think even in 2018 up to 2020, it really was very, very mom and pop. And so I don't know, maybe you could speak about how you see self-storage at sort of the state right now, and then sort of what you see happening going forward in that specific asset class.
Sure. Yeah. I guess the short answer, Jason, is that it is still a highly fragmented industry. So the big names that Public Storage, Extra Space, Cube Smart, Life Storage, those big brand name companies, even though they've been growing and expanding and acquiring existing facilities and building new ones, they still only control about 35% of the overall self-storage market. And then there's kind of a layer beneath them, which are larger regional players. I don't know that Bellrose Storage Group quite fits into the larger regional player just yet, but we're working toward that. And that's only maybe another 10 or 15%. So that still leaves about 50% of the overall self-storage market, Jason, is still moms and pops. These are onesie, twosie facility owners. And what is exciting about that is these are folks who aren't professional operators. They're not running their storage facility like a finely tuned business. Mm-hmm. Their goal at the end of the day is just to keep their units full, and they get their mailbox money and then they just kind of go on with their lives, because the last thing they want to do is have to deal with the delinquency, have to deal with turnover, have to deal with marketing, have to deal with any kind of advertising and that sort of thing. So they leave their rates artificially low so that they leave their units full. And anybody out there who's in any kind of fixed cost industry like hotels or airlines or anything like that, if you're full, that's a bad thing. You're not charging enough. And you also want to make sure you have units available, so when someone does come in, you're not turning them away. So when we start getting to about 90% of physical occupancy, we really start analyzing. Well, we're always analyzing, but that's when we really start looking at changing our rates, because we want to make sure that we're really working that that supply and demand curve, kind of back to your first year of business school. It's finance 101 and economics 101. So that's all we're really doing. But we do come in with our professional management team. Like I mentioned, Catherine East is an expert in the space for many years. And then we're using software. Believe it or not, a lot of moms and pops, they might have software in place, but they might be using about 10% of its capabilities. They're not really pushing marketing. They're not using like something simple like Facebook ads, right? To really drive that demand and make sure that they are pushing the rates, because at the end of the day, we're looking at what's the overall revenue, not just is the occupancy 100%. So we're looking at those KPIs at all of our facilities all the time, those key performance indicators. So it's physical occupancy, economic occupancy, delinquency. Auto pay is a big one. We love getting customers on auto pay, because then it becomes like a Planet Fitness membership, where it becomes more of a pain in the butt to cancel it than to just let it ride for another month or two. And then those are the big things that we're looking at. But we run it like a business, and that gives us the opportunity to take these mom and pop run facilities that are not being optimized, and we can increase the value of those and generate a nice return for our investors.
Yeah, it's some really interesting points there. I think that the occupancy thing it is funny. It's people I know this goes back to just school or what, but like people love to see 100%, or as high in the 90s as you possibly can. But it's like, if you're at 100% and you have a waiting list, whether it be self-storage or hotel or multifamily, you're actually not charging enough, right? You've got to look at what what that number is that creates slightly lower occupancy, but that means you're sort of maximizing the revenue from each specific unit. So I love that you brought that up, because I think it's sometimes lost on people. And I don't know, from a financing standpoint exactly how it works in self-storage, but I know for sure on the multifamily side,
even if you have 100% occupancy, the bank's maximum going to give you credit for 95%, and probably realistically more like a low 90s as far as what your occupancy is. So it doesn't necessarily benefit you to be 100% full. And honestly, I hadn't thought about the part of that you mentioned where you want to have a spot for someone to go, if they come in looking, so you're not turning them away. I think that's actually a really great point, and maybe that's slightly more applicable to storage, but who knows? I think these kind of go cross asset classes, these types of concepts, as you said, sort of basic finance and economics 101. So
That's right.
it's a great point. What challenges, what pain points do you see in self-storage that you think would be, you would consider unique to that asset class?
Unique to storage, huh? Well, unique to
And they
storage.
don't have to be unique, I guess. Maybe that's
Yeah,
probably
yeah.
the wrong way to put it. But what challenges do you feel like you run into within your business?
Sure. Yeah, so we're so here we are in July 2023. The market's been tough, right? Interest rates are up. There's a disconnect between sellers and buyers in terms of value. So the market's definitely slowed down. And I'm very thankful right now, Jason, that we only, across our entire portfolio, we only have one variable rate loan, because I know some people got in a position where they took on some variable rate financing, and those rates are way up now. So so that's made things very challenging, not only for self-storage but other asset classes as well. One thing that is a kind of a derivative of the housing market, right, is self-storage demand. So the fact that the housing market is slow right now, people are not moving around as much right now because financing is difficult. Just like in commercial real estate and residential real estate, financing is difficult, home prices are high. That just that combination just has caused a slowdown in the residential market, which causes a slowdown in self-storage. Because one of the drivers of self-storage demand is that kind of disruption where people are moving about the country, and they need a place to store their stuff, either temporarily or even for a longer period of time while they're adjusting their housing situation. I guess the silver lining there, though, is that over the past 40 years, self-storage occupancy has kind of gently bounced between like 80 and 90% across all facilities across the country. Meanwhile, over those same 40 years, the economy has been going up and down and up and down and up and down everywhere in between. So that's one of the things that attracted us to self-storage, is it is resilient. I certainly won't say it's resistant to any kind of economic challenges, but it certainly is a resilient asset class. And it does have low operating expenses. So we are able to run our facilities pretty lean. So aside from taxes, insurance, and those kinds of things, our payroll is generally pretty low because we do leverage technology to limit that expense. So that does give us the flexibility in the event that we need to lower our rates, we can still generate enough revenue to cover our expenses and our debt. So what you'll see there is that translates into virtually a 0% default rate on self-storage loans out there in the world, whereas office, retail, hotel, they have some higher default rates for sure, and they're probably going to be going up here as we head into some more economic headwinds. But our challenges too are a development, right? So we're trying to find markets where it's kind of the Goldilocks situation, Jason, where it's a growing market, but it's not growing too fast, because if it's growing too fast, it's going to attract one of the big real estate investment trusts, right? One of the REITs, public storage, extra space, etc. and they're going to build some 100,000, 200,000 square foot facility, and they're going to suck up all the demand in that market. Whereas on the other side, we certainly don't want a declining population market, because that just is going to erode self-storage demand. So we like to find that Goldilocks situation where the market is strong, but not, super hot. But that can be challenging, right? In these economic times, just finding that right market. So we do spend a lot of time when we do find a subject property. We spend a lot of time looking at the market, looking at the population, looking at the economy. Is it a diversified economy? So are there lots of different sources of jobs? Because we certainly don't want to find ourselves in a one factory town, and that factory goes out of business and the town goes out of business. So,
right.
So we're looking at all those factors. But we're of all the kind of the bumps and challenges that are out there right now, I think self storage is a very resilient asset class that can handle them.
Yeah, it makes sense. I mean, I guess it sounds like there's maybe not a tremendous amount of unique challenges, because these are things that we see, in multifamily as well, but maybe more stable, maybe more a lot less subject to the volatility that we might see in some of these other asset classes, even though in a market downturn there's sort of affects everybody, but maybe not quite to the same extent. It's very interesting. Well, Tom, I want to switch gears so I get time to ask you the questions I like to ask every guest. The first one is based on the name of the show, and so I'll ask you, what is your why? What drives you? What sort of motivates you? You've obviously had a lot of success in your career, but you're not stopping. You're not retired. It doesn't sound like you're retiring tomorrow. So what keeps you motivated?
Yeah, it's a great question, Jason. I think what keeps me motivated is just the desire to continue to learn and grow as a person, especially now. So I know you've got little kids running around at home. My kids are almost 21 and 18, so they're kind of heading off into the world. And of course, thanks to my entrepreneurial career, I was able to spend a ton of time with them while they were growing up. But now they're leaving the nest. And so now it has caused me, Jason, to kind of rethink and shift my why a little bit, make it actually a little bit broader, because of course my why as the kids were growing up was, make sure to be, the best dad I could be for them. And now, that role is changing, right? So I'm being a dad of a 21-year-old is much different from being a dad to a 2-year-old, right? So what I find myself thinking about now, and what's motivating, is not only being an example and a role model for my kids, but also other people that might be just starting out in an entrepreneurial career. Maybe they're considering getting into real estate, or maybe they've got a great corporate job and they can't do the real estate stuff themselves, but they see that it's a way for them to build wealth and maybe get out of their rat race. So I like to just kind of mentor and those people, unofficially. It's not like I'm a guru out there selling a course or anything, but I do have some people that I just talk to from time to time, meet up for coffee. I have a young guy here in Philly that I've been a mentor of for probably 10, 12 years now. And his business he's in the residential real estate business, which is kind of ironic, but I've been kind of mentoring him along the way, and his business is thriving. And now he's got little kids, and he's able to now look at sending them to private school and things like that. So it's more of those kind of the whole giving back thing, Jason, has been what's motivated me. Along those same lines, I was able to start a scholarship at my alma mater in honor of a classmate of mine, a friend of mine who passed away. So having the resources to be able to do things like that, I think is really exciting for the next chapter of my life as a empty nester, and wanting to be just, I want to learn as much as I can so I can give back as much as I can to anyone who's willing to listen.
Well, I hope they're willing to listen. You've got a lot of value to provide, a lot of knowledge and experience that I think people can really get a great deal from. So I love that. I do find with a lot of guests, the why shifts over time. A lot of times there's some level of family involvement, but yeah, I think at some point, if you've done things well, then at some point those kids grow up and don't not that they don't need you as someone close in their life, but they don't necessarily need quite so much support. And so you kind of, where do you take that where do you take that energy? And so it's great to be putting it into those causes. Second question, tell us something about yourself that isn't common knowledge. Special skill, a hobby, something just to let the listeners know you a little better.
That's not common knowledge. Okay. Well, I think a lot of people might know that I'm a golfer, but I don't think a lot of people know that I'm a wannabe rock and roll star. So I grew up playing music. I've been playing guitar since I was 11 years old. I had the garage band in high school. And then, of course, you kind of get into life and, I still play a little bit now and then. But I think now that I am an empty nester, I have a friend of mine who's in a band and they just play in local bars and events here outside Philadelphia. And I was talking to him like, man, how'd you get into that? I'd love to do that. And so he's sort of mentoring me because he's got a full-time job, right? He's just kind of doing this on the side. But I think now here in my empty nest chapter, I think I'm going to be looking to get back in front of people and entertaining with little music.
I love it. I also had a garage band, and but at this point my guitars are pretty dusty from there's a lot going on. But yeah, I definitely enjoyed it, and it would be at some point. I see it as my kids get a little bit older, they can start learning to play, and I can sit with them and play a little bit. It'll be fun. When people hear this, Tom, and they want to reach out to you, what's the best way?
Sure. Jason, this has been great, buddy. Thank you so much. I'm Tom Dunkel. I'm the Chief Investment Officer at Bellrose Storage Group. You can find us at bellrosestorategroup.com. You can I'll just do a little plug on our website. You can find an ebook that's free. It's called The SAFE Method. SAFE is an acronym. And it's basically a due diligence checklist for investors out there that are looking at different investments, and maybe they're just having a hard time. Where do you get started? What questions do you ask? So the SAFE method is a framework for those questions to get answered, so that investors out there can make educated decisions. So just real quick, S stands for sponsor. So who's running the deal? What's their background, et cetera? A is the asset. What is the asset that you're actually investing in? I would love crypto investors to explain that one to me. Whereas in self-storage, right, it's a metal box with a concrete floor and a roll-up door. It's not super complicated, but that's the asset. F is for financials. What are the financial projections? What are the financial implications? What are the what are the returns? Are they achievable? Are they reasonable? And then E is exit. How do you get out of this thing, right? You can't go to schwab.com and click and sell your position in a Bellrose Storage Group deal, because it just doesn't work that way. But so you need to be comfortable with what the exit strategy is. When does it happen? What has to happen for it to happen? And those kinds of things. So that resource is available for free at bellrosestorategroup.com. And you can also find us on LinkedIn and Facebook and other cool places.
Great. We'll definitely put that in the show notes. Last question for you, Tom, before I let you go. What piece of advice would you give to someone who is getting started in real estate? What it sounds like you're doing some mentoring. So what do you tell people, kind of to get them moving in the right direction?
Yeah, great question. So this past January, I gave a 40-minute talk to about 400 or 500 conference attendees, more or less about this subject. And to me, over my career, my experience, when I was successful, I did these three things. When I was not successful, one of those three things was missing. So the three things are: find a niche, get really, really good at it. Number two is build a team around you. We talked a lot about that, Jason, with the who, not how. And then number three is get educated and get the tools that you need to execute on your business plan. So those are the three keys. When I was successful, I had all three. When the ventures that we were on, that we tried out, where that failed, and there were plenty of them, one or more of those three things was missing. So make sure you got the team, the niche, and the education and the tools you need.
Makes total sense. Thanks, Tom. Thanks for coming on the show. Thanks for sharing all this. It's been great talking to you. I appreciate everything, and you taking the time out today. So thank you.
Thank you, Jason.
All right, folks listening, I know you're going to get a lot of value here. So please like, rate, and review the show so we can get more great guests like Tom. All right, thanks for listening.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.